Good morning, esteemed judges and faculty. On behalf of the team from George Mason University, we are pleased to present our valuation of a 51% controlling interest in KH&M Holdings, which is a fictional name for our company today.
Hi, my name is Huzaifa Shafiq, and I am a current undergrad student at George Mason University in my senior year studying Management Information Systems and Finance.
Hi, my name is Kevin. I'm an undergraduate student at George Mason University in my senior year, currently studying accounting and finance.
Hi, my name is Noah Fleifeld. I am an undergraduate student at George Mason University in my senior year, studying finance.
Hi, my name is Mariana. I am currently pursuing a master's in finance at George Mason University. I also hold a master's in public administration and I currently work in international development.
Now, let's take a look at the agenda for today. We will begin with an executive summary for our findings before formally stating our valuation objective. From there, we will provide an overview of KH&M Holdings and the broader industry landscape in which it operates. We will then dive into the core of our analysis. Finally, we will address some risks and summarize with our final conclusion. Let's begin with the executive summary. Our concluded value of 13.3 million for the 51% stake is derived from a 100% firm equity value of $26 million. This figure represents a carefully weighted synthesis of three distinct analytical pillars, which you can see summarized on the slide. First, our discounted cash flow analysis, which looks at the company's intrinsic ability to generate future cash, yielded a value of $18.1 million. Second, our analysis of guideline public companies indicated a value of $33 million. And third, our review of precedent M&A transactions suggested the highest value of $34.6 million. We placed a 50% weight on the DCF method, and it best captures the specific operational realities and future potential of KH&M as private entity. This valuation was performed against the economic backdrop of early 2024, a period characterized by elevated stabilizing interest rates. This macroeconomic pressure directly informed our calculation of a 13.5% WACC. However, our analysis also gives significant credit to KH&M's impressive performance, having successfully navigated pandemic-era disruption to achieve over 75% revenue growth from 2020 to 2023, demonstrating a robust business model well positioned to capitalize on continued strength in industrial and service-based economies. Now let's take a look at our valuation objective. Our objective for this engagement is to provide a sound, independent, and defensible opinion of the fair market value of a 51% controlling interest in KH&M Holdings as of March 1st, 2024. The purpose of this valuation is to equip the board of directors with the actionable intelligence for strategic planning, whether the future holds a potential sale, a merger, or internal capital restructuring. This report serves as a foundational tool for informed decision making. We recognize that valuing a private enterprise like KH&M requires moving beyond formulas. It demands a nuanced approach for understanding of the factors that don't always appear on the balance sheet. Our approach therefore incorporates specific data-driven adjustments for the risk and realities of the private market, including a 29% size premium and a 3% company-specific risk premium to account for factors like market concentration. Our work adheres to the highest professional standards, ensuring our conclusion is grounded in accuracy, transparency, and direct relevance to the strategic challenges of 2025 and beyond.
We started in Texas back in the late 70s with one simple goal: to protect the people who keep our industries running. Since then, we've grown into a multi-channel leader in workwear and protective gear, serving oil and gas, utilities, and construction. What makes us different? We do our brodering in-house, even with flame-resistant threads, so orders go out fast. We keep extra inventory on hand so no emergency order goes unfilled. And our mobile boot sizing unit, it goes straight to the job site. As a family-owned company, we've built resilience into everything we do: a strong teams, solid processes, and real partnerships that last. Let's begin with an overview of the industry and market context that shapes the company's performance. Understanding these macro trends helps explain how the firm's growth connects to the broader U.S. economy. The company's performance moves in step with the broader U.S. economy, serving the industries that drive national growth: energy, utilities, and construction. When infrastructure and industrial investment rise, demand for protective workwear and safety equipment increases as well. Historically, the company's growth has followed the same economy rhythm as these sectors, expanding in upswings and focusing on operational efficiency when markets soften. That adaptability has been one of its defining strengths. From February 2024, the U.S. economy entered a period of measured stability: GDP growth near 2%, inflation easing towards 3%, and interest rates holding between 5.25 and 5.5%. Across industries, businesses emphasized productivity, risk management, and reinvestments, values already embedded in the company's operations. Building on that economic foundation, it's important to look at the federal policies and investments driving demand in the company's core industries. The industrial workwear and PPE market remains resilient, supported by a strong activity in energy, utilities, and construction. Two major federal initiatives have amplified this momentum. The Infrastructure Investment and Jobs Act, enacted in November 2021, directed more than $550 billion towards transportation, energy, and broadband infrastructure. The Inflation Reduction Act of 2022 added powerful clean energy tax credits and manufacturing incentives that continue to fuel renewable and industrial investments. Together, these policies have strengthened long-term demand for protective equipment, the products at the heart of this company's mission. Still, the 2024 presidential election introduces policy uncertainty. Diverging approaches to energy, taxation, and regulations could shift capital flows among sectors, reinforcing the need for flexibility and diversification in strategy. Now let's turn to how the company is strategically responding to this market and policy trends. Once concentrated in oil and gas, the firm has diversified into electric utilities and other high compliance sectors to reduce exposure to commodity cycles and align with the energy transition. Investments in in-house embroidery, fast customization, and efficient logistics support expansion into adjacent markets where reliability and protections are essential. With strong fundamentals, disciplined cost control, and a focused diversification strategy, the company is well positioned for sustainable growth amid an evolving economic landscape. Now I am passing it to Kevin to go over the historical and projected financials.
Let's start with the historical income statement. The business moved through three distinct phases. First, 2020 through 2021, where sales declined as COVID-19 suppressed industrial activity and the energy sector experienced a sharp price crash. Supply chain inflation further compressed margins, with freight, lead time, and input costs all rising faster than what we could reprice. Phase 2 begins in 2022 as restrictions lifted, industrial demand rebounded, and field activity resumed. We saw a stronger order flow, better labor utilization, and improving procurement, helping gross margins stabilize within a roughly 3-point range. Operational expenses also began to normalize as COVID-19 related inefficiencies rolled off. Phase 3 is 2023, which was a banner year as revenue reached $58.4 million, which is roughly a $9 million year-over-year increase, with margins still holding steady. Looking at the historical balance sheet, liquidity is solid. Working capital improved alongside sales, with the current ratio currently remaining above 2, indicating ample capacity to meet short-term obligations even through cyclical swings. Inventory turnover has trended up as demand normalized, and total asset turnover has risen, all evidence that the asset base is being deployed more efficiently to generate revenue. In short, the company is not only growing the top line, but also using its assets better each year. On the liability side, leverage remains conservative. The debt to assets ratio sits in the mid-30s and has been stable to slightly lower, which reduces refinancing risks and provides optionality for future growth through investments. Combined with the healthy current ratio, this capital structure positions KHNM to absorb volatility in cycles that are correlated with energy prices. Looking at our managerial projections, looking ahead, our 2024 forecast assumes increased sales and modest margin improvement. This can be a result of operational efficiencies from the post-COVID reset, which are still sticking. This results in management projections for 2024 through 2028, suggesting sustained growth, albeit in a very conservative manner. 8% in 2024 through 2025, which then tapers to 5% afterwards, reflecting both conservative assumptions as anticipated revenue stabilization as the company diversifies away from oil and gas and into a broader industrial consumer base. Gross margin is still modeled to remain within a tight range, consistent with the historical pattern, while operating margin holds near the low to mid single digits with scope for upside if mix and utilization continue to improve. Expense growth runs below average growth, reinforcing operating leverage. There are all risks when it comes to forecasting the future. End market demand is still partially tied to energy price cycles, regardless of diversification. Labor markets will also remain competitive, and logistics costs can re-accelerate. Our mitigants are deliberative. With a strong liquidity cushion and a conservative balance sheet, KHNM is positioned to invest through the cycle without stressing the capital structure.
For this valuation, we approach the analysis from a controlling interest perspective since we're valuing 51% of the company's stock for corporate planning purposes. In other words, our goal wasn't to determine a passive minority value, but rather what the company is worth to an active owner with operational control. To determine our discount rate, we used a modified cost of equity framework to derive the overall cost of capital. Starting with the cost of debt, we arrived at a pre-tax rate of 5.5%, which after accounting for the company's tax shield, resulted in an after-tax cost of 4.35%. For the cost of equity, we incorporated a risk-free rate of 4.19%, a beta of 1, a market risk premium of 5%, a micro cap size premium of 2.91%, and a company-specific risk premium of 3%. The 2.91% size premium was taken from Duff & Phelps, now known as Kroll, which publishes size premiums by decile. Because our target company falls within the microcap range, specifically within the 10th decile, this premium appropriately reflects the additional return required for smaller firms. However, applying the highest available premium would have unfairly penalized the company given its private status and strong growth potential. Therefore, we chose the more modest 2.91% to represent a fair and balanced estimate. The company-specific risk premium was based on three primary factors: projection risk, technology risk, and market concentration risk, all of which we identified earlier as key uncertainties facing the business. Combining these assumptions with an industry-aligned capital structure based on peer comparables resulted in a weighted average cost of capital of 13.5%. Using our discounted cash flow approach, we derived an implied value of approximately $9,250 per share. We applied a long-term growth rate of 3.5%, which is slightly above projected US inflation to reflect modest real growth potential. When we stress tested the perpetuity growth rate, our sensitivity analysis produced a valuation range between $7,714 and $12,503 per share. We also considered using the exit multiple method, testing a range between 4.8 and 8.2 times enterprise value to EBITDA. However, since the valuation is being performed from a controlling interest standpoint for planning purposes rather than an imminent sale, we decided not to rely on exit multiples. Exit multiples are more appropriate for transaction-based valuations, whereas in this case, the company is expected to remain private. For that reason, the perpetuity growth method provides a more accurate reflection of the intrinsic value under long-term ownership. Turning to our comparable companies analysis, we examined public peers within the diversified support services industry. After adjusting for size, we found that the enterprise value to EBITDA multiples typically ranged from 12 to 17 times, while enterprise value to revenue multiples ranged from about 1.3 to 2.3 times. Because our target company is significantly smaller, roughly 2 to 6 times smaller in revenue than its public peers, we applied a downward size adjustment to these multiples. Ultimately, we selected an enterprise value to revenue multiple of 0.7 times and an enterprise value to EBITDA multiple of 12.2 times. After incorporating a controlling interest adjustment, this approach resulted in an implied share price of approximately $16,845.
Now, turning to our other market-based methodology, the guideline transaction, or GAC method. This approach provides a powerful real-world benchmark by analyzing the prices that strategic and financial acquirers have actually paid to acquire small businesses. As summarized on the slide, our analysis focused on four key deals within the workwear, footwear, and facility services sectors, including Cintas' strategic acquisition of G&K Services and VF Corporation's purchase of Williamson-Dickie. These transactions provide excellent insight into the multiples the market is willing to pay. From this set, we observed a median EV over EBITDA multiple of approximately 12x. For our evaluation of KH&M, we selected a slightly higher multiple of 13x. This upward adjustment is deliberate. KH&M's superior post-pandemic growth trajectory and strong and consistent profitability places it in the upper tier of operational performance compared to the transaction set, thus warranting a premium. Conversely, the EV over revenue multiple, we adopted a much more conservative stance, selecting a 0.7x below the 1.1x median. We view revenue multiples as a secondary check, as profitability and cash flow, which are KH&M's strengths, are the primary drivers of value in the support services industry. By applying a 75% weight to the value from our 13x EBITDA multiple and a 25% to the value of 25% to the value from the revenue multiple, the guideline transaction method yielded a concluded equity value for KH&M Holdings of $34.6 million. This represents the highest value among our three methodologies, appropriately reflecting the strategic premiums often realized in a competitive M&A market. Now I'm passing it to Mariana to go over some key risks.
Let's turn to the key risks that could influence the company's outlook and valuation. Like any business in cyclical industries, performance depends not only on execution, but also on a broader market and policy conditions. We group these risks into three main categories: projection risk, technological risk, and market concentration risk. Projection risks remain the most significant, as it reflects both internal assumptions and external uncertainties. The company's forecast growth from about 58 million in 2023 to 63 million in 2024, with continued expansion through 2028. These projections rely on stable demand, manageable costs, and consistent performance in core markets. If inflation persists, supply costs rise, or clients delay orders, results could fall short, directly impacting the valuation. A related challenge is labor retention, particularly in retail and customer service roles. Many younger employees have left for slightly higher pay or better benefits, increasing turnover. To address this, management has raised wages, improved benefits, and introduced individualized performance reviews on each employee's work anniversary, helping distribute raises more evenly and sustain motivation. Despite these pressures, efficiency gains from new workflow software have allowed the company to maintain strong customer service and productivity levels. Projection risk also includes supply chain pressures, competition, and political uncertainty. The company depends on multiple suppliers for its PPE and uniforms, so manufacturing delays or rising input costs could reduce margins. Larger national competitors also pose pricing and marketing challenges. On the external side, inflation, interest rates trends, and fiscal stimulus under the Infrastructure Investment and Jobs Act continue to shape industrial demand. Yet, the 2024 US presidential election adds new uncertainty. The Biden campaign supports expanding clean energy incentives and renewable infrastructure, favorable for utilities but less so for oil and gas. The Trump campaign favors increased drilling and reduced clean energy subsidies, a potential boost for oil and gas, but a slowdown for renewables. This policy contrast could materially shift capital flows across the company's client base. Technological risk is another key area of exposure. In October 2023, hackers attempted to access the company's bank accounts. While no funds were lost, the incidents reveal weaknesses in authentication and system monitoring. Management responded by strengthening online controls and implementing real-time oversight. The company is also investing in a 1.2 million website modernization project scheduled through 2026, which is central to its e-commerce growth strategy. However, if this project faces delays, cost overruns, or technical issues, it could hinder online sales and expose new security vulnerabilities. Beyond operational disruptions, a significant cyber breach could also harm the company's reputation and customer trust, particularly as more transactions and clients' interactions move online. Maintaining digital reliability is therefore not only a technological priority, but also a key reputational safeguard. Finally, market concentration risks reflects ongoing exposure to oil and gas, which still account for around 60% of total sales. When oil activity slows, demand drops quickly. Management is working to diversify into utilities, construction, and other industry sectors, but this transition will take time. Geographic concentration in Texas also add exposure to regional slowdowns or severe weather events, highlighting the need for continued expansion into new U.S. markets. In short, while the company's fundamentals are strong, its outlook depends on managing these three critical areas: forecast execution, digital resilience, and successful diversification. Now I'm passing it to Noah to conclude our presentation.
In conclusion, by integrating all our valuation approaches and weighting each method based on our confidence in its underlying assumption, we arrived at a final equity value per share of approximately $13,248. This implies a total equity value of roughly $13,247,797 for 51% of the company's stock. This valuation reflects what we believe to be a fair and supportable estimate of the company's worth under a controlling interest framework, grounded in industry norms, realistic growth expectations, and a risk profile that accurately captures the company's current stage and market positioning. Thank you.